My name is Joe Perfetti. I teach equity analysis at the University of Maryland College Park. And today I'd like to talk to you about the run-up in share prices after the U.S. election that ended on November 3rd, 2020. A lot of people were surprised that stock prices rose so dramatically. In fact, this is a 3-day look at stock prices based on the S&P 500 index, which is of the 500 largest companies in the United States across many different industries, chosen by S&P. And basically what you can see here is that there's a big jump over the last 3 days. This was election day, big jump the day after the election, and then another big jump 2 days later. And trying to understand why. Well, I like to give you sort of a financial reason for that. Basically what ended up happening is this is what we call in finance the key value drivers formula. And essentially there's a lot of information on the screen, but these four variables determine what's called the enterprise value or the overall value of a company. If we look at a company long term, it's a variation of what's called a perpetuity. But basically a company stock price is a function of the future growth in its cash flows, the tax rate it's paying, the return on the investment it generates, and the cost of capital, which is the hurdle rate on the expected risk expected of the company. Now, the return on invested capital is also a function of the forecasted margins of the company and also a function of the tax rate after tax margin, it's called the NOPAT margin, and then it's also a function of what's called the productivity, which is the level of investment in the balance sheet. But what I wanted to say is if you actually look at the data today from Bloomberg, what you can see is that the enterprise value of the S&P 500, which is basically the value of the 500 companies of the index on a weighted basis, is $39.93.21, essentially per share equivalent. And the forward expected earnings that the Wall Street community expects these companies to make on a weighted basis next year is $176.14. And so if you take the $39.93 and divide by the 176, basically what you're doing is you're paying, right here the actual, 22.67 times next year's earnings is the multiple on what's called the EBIT or operating profit, earnings before interest and tax, of the companies. So again, one more time, right now I'm paying about 22.67 or 23 times next year's earnings, the expected earnings, for this index, right? And that's the data that we have today. So here's basically what's been happening. One of the drivers of this is the tax rate. Now, 3 years ago, the corporate tax rate was 35% in the United States, and it was lowered to 21%. And last year, these companies paid about 15.5%. So if I try and understand the index today, what's basically been happening is companies are supposed to pay 21, but through tax deductions, overseas sales, etc., they pay about 15.5. It's the average tax rate of a big company in the United States, growing about 3.6% a year, assuming about a 10% return on investment and a 6% expectation of return. Watch what happens when this tax rate goes from 15.5% to, and I'm just going to assume it goes up by 7 points to 22.5%. Watch what happens to the enterprise value to EBIT here. This is the calculated result of the data. So this is what the academic formula says it will be based on these assumptions. This is what we've observed in the market today on November 5th, 2020. And basically what's happened is you notice this, that instead of the matching, that basically we saw about a 10% drop in the share prices. And the reason why I chose 28% or 7 points more is that's what the Democrats had promised if they won the White House and if they won the Senate, they were going to raise the corporate tax rate too. And it was almost a foregone conclusion that that was going to happen as of November 3rd. Well, that did not happen. It looks like, despite what is going to happen with the presidency, that the Republicans are going to retain control of the Senate. So what Wall Street said is, surprise, we don't get the tax hike that we expected. So the tax rate, which instead of going to go up from 21 to 28, is probably going to stay at 21. And what ended up happening is instead of depressing the share prices where they were a couple days ago, by basically saying, gee, we're not going to pay as much as we were expected in taxes. It's probably going to stay around that rate of, call it 15.5%, again, about approximate round off. Then basically I go back to the share prices where I was originally expecting, and that's going to be a run up at about 10% in share prices. And so what happened over the last 2 days is that in anticipation of that, show you a different chart, basically between November 4th and November 5th, share prices have gone up about 4.19 or 4.2%. So again, what was really happening with the share price run up? There was an expectation for a rise in essentially the tax rate, assuming a complete Democratic sweep. That did not happen. It looks like there's going to be a split Congress. Therefore, Wall Street is readjusting their pricing, assuming a lower tax rate. And as a result of that, what was priced in as an expectation of a higher tax rate changed. And now you see an adjustment in price. The more you know.